Joining us right now to talk more about that is LJH Investment Advisors Managing Director, Media and Entertainment Analyst Larry Haverty. Larry, it's good to see you. Thanks very much for being here.
Hi, Maria.
Has anything changed in terms of the backdrop for the large media technology companies that we're talking about today, like Google, for example?
I absolutely think it has, Maria. You know, you look at these stocks, and they've been almost a religion, and I think some of the people are getting out of church. Putting that in financial terms, if you look at, and I think Amazon's the easiest place to start, if you look at their report on the surface, it looks terrific. They had a very, very strong revenue growth, stronger EBITDA growth. The margins improved. There's a lot of free cash flow. But if you look below the surface, you can see the beginning of some warts developing. I think the thing that struck me was that the foreign growth was only 15%. And you have a stock that's up in the neighborhood of $250 billion of sales, and it sells at these multiples. You have to have foreign growth. And you look at India as a foreign market, and Amazon is used to having more or less things for themselves. And Walmart is going to compete very vigorously in India. They just bought a local guy, and they told their shareholders that they weren't going to make a whole lot of money there for the next couple years, and the shareholders sent the stock up. So that's a warning sign to Amazon. The second warning sign, Maria, I think you talked about it earlier, and I'm very concerned about it, is I think there's going to be margin pressure from this shortage of employees. You go down to Florida, and there are so many help wanted signs. I just don't think there are any legal workers available in most markets, and they've got to find 100,000 people at a time when the seasonal pressures of employers to add workers is very high. So I think you're going to have some inefficiencies in the fourth quarter.
There are a lot of things coming together to sort of create this uncertainty. Earlier this week, we spoke with Alpha One Capital Partners founding partner Dan Niles, and he summed it up this way.
This is the longest bull market in the S&P 500 since World War II. It's been up for 115 months. The gains over that period of time are up over 330%, which is the second biggest gain during a bull market since World War II. But if you look at the big picture around growth, you've got a lot of concerns. You've got China starting to slow down. Auto sales in China went from being up 15% year over year in April to down 10% in the most recent month. That's a pretty big change. You've got concerns over Italy and Brexit in Europe. And in the U.S., interest rates are going up. They're at the highest levels in 7 years. What you've seen in general during this earnings season, with Boeing being a pretty big exception, is that a lot of companies are guiding much lower. I'll give you an example. Texas Instruments reported last night, and I think they're one of the best indicators in terms of global health. They do about $16 billion in revenues, $100 billion in market cap. They missed revenue expectations for the first time since the fourth quarter of 2015. So it's been almost 3 years since they missed the top line. They talked about every major end market slowing down, and they weren't sure when it was going to stop.
Are we looking at fundamentals deteriorating within technology?
I think you absolutely are. And this is exacerbated by the fact that you have a lot of inventory out there. So if you pick the biggest company in the world, Apple, for example, they have 89% inventory growth year over year in the June quarter that they reported. Their revenues were up 17%. Well, what if the iPhone doesn't sell well? They're going to have to burn that inventory off when we get into the March quarter.
There you go. And that's why we're seeing revenue under pressure, Dagan.
Right. Dan Niles was mentioning the Texas Instruments revenue, but Larry, 43% of the S&P 500 companies that have reported so far have missed revenue expectations. That is a big number, and certainly the biggest percentage that we've seen this year. One viewer noted on Twitter, don't the earnings matter more than the revenue? And I said, well, you can get to earnings by cutting costs because your taxes are lower. Ultimately, if you're a growth company, you better be growing that revenue and faster every quarter.
Well, if you didn't like the third quarter, you're for sure not going to like the fourth quarter, because the dollar's strengthening, and in the fourth quarter, sales are seasonally stronger, so the mountain's higher. So you're looking at a fourth quarter where, just because of this labor thing, you're going to have employment shortages and margin pressure. You're going to have interest expense going up way more than it has in past years. I think it's really been 30 years since we've had a good interest rate cycle, and we've got a good interest rate cycle going at least until the last couple of weeks. And
right.
It doesn't look like you're going to get any help from China. China's being very difficult, and I think the political situation there is scary. So there's plenty of room for caution, especially since stocks aren't. I think stocks are reasonable now. I don't think they're expensive, but they certainly aren't cheap.
Yeah.
I was going to say, I mean, earnings are growing at 20%, and after all, that does bring the multiples down. I'm not talking about tech necessarily, but overall, it seems to me valuations are pretty good.
Well, I think right now you're at a point where most of the companies can't be buying the stock in the market because they're
which is another big factor.
in the reporting mode.
Point.
And the market has usually bottomed in October. And another thing that doesn't get a lot of press is mutual fund tax loss selling. Most mutual fund companies try to minimize their tax liabilities by selling their losers. So there's a lot of pressure seasonally on the market, and that pressure is going to erode. And I think people are going to be looking at the 10-year at 3.08% and saying, oh, my gosh, let's buy a couple stocks. I can get a 5% plus yield in the telephone company and Verizon. You know, what's so bad about that now that they have media exposure to make them grow a little faster?
That's a good point. And
I think
Michael,
we're close to the bottom.
Yeah, Michael, you know what Dan Niles said the other day? The average dividend yield within the S&P 500 is 1.8%. So you get 3% in the 2-year versus 1.8% in the stock market? There you go. I mean,
we'll see. There's a trade-off there. Larry, one thing really quickly here. You know, we're talking about wage pressures and the effect it may have on margins. I heard this argument 6 months ago. Retailers were supposedly going to go down on this. Banks were out pitching hedge funds on baskets of stocks they should short because of wage pressures. Well, guess what? Those retailers were able to pass along price increases. That was spelled out in the beige book and another evidence we got, and those retailer stocks continued to rally. Do you think that scenario could be repeated here? Can retailers pass along price increases into holiday season?
I think the retail stocks rallied because they were trading at 6 to 8 times EBITDA versus 30 plus times for Amazon and close to 20 plus times for Google. So the stocks were very undervalued. I think there's going to be margin pressure. There can't not be. The world is just very, very competitive, and rates are up, and wage costs are going to be up, and you can see this in the macroeconomic statistics. So I think the seas are going to be rough, but we're at a level where there's still a lot of free cash flow. The world certainly doesn't need more retail stores. Google's really the only company that I can see that is really sharply accelerating their capital spending. And we'll see how that works later on. And I think a lot of that's related to Waymo, which I think is going to be potentially a big proposition. So I think it's going to get worse before it gets better, but I think we're very close to where it's going to get better. And there are a lot of good things going on, and I think they're going to be recognized. But first, we got to get through this seasonal pain and some stock-specific pain when margins go down. Because so much money is being managed now by machines. And machines have been programmed not to like margin pressure.
Of course.
You need to get out of the way of the machines when they're doing their thing.
Also, machines and humans, they don't like margin pressure either. Larry, it's good to see you this morning. Thanks very much for your insights.
Thanks, Maria.